I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward to what might happen in the next week. And hopefully lots of great ideas and opportunities for you throughout the show. Well, the stock market resumed its corrective ways on this last week. That's after the previous week's rebound just encouraged more selling. Background news continued to focus on the trade war as the U.S. and China seem to be deeply entrenched in their own protectionism. China says they are readying more retaliation, and we've seen some of that commentary coming late here in the week. Heavy selling came early in the week as Google and Intel and Qualcomm all cut ties with Huawei, and that even seemed to get more comments out of China as they acted to delist the largest chip maker, largest Chinese chip maker from the New York Stock Exchange. So it's going back and forth. Japan even joined that blockade, and they've blackballed Huawei also, so it's really moving across the world. Mnuchin, he tried to calm the markets, of course, said, well, we'll be open talks with China. We'll just come back to that starting point where we were before. Well, good luck with that. And Trump says that he and Xi, they're going to see each other at G20. Of course, we don't know if they're just going to be waving to each other. There probably won't be a lot of discussion about the trade war. Fed minutes showed more bull than truth. They said they're a slowdown. They call that slack in the economy. And they say, well, inflation is low, but of course they call that transitory. And they say there won't be a rate cut for some time. And even if the economy improves, they won't be raising rates, so they're doing everything they can. Why don't they just say the truth? Truth is the economy is crap, and around the world it's really slow. And this is all the trap that the Fed and the central banks got us into by having all of this incredibly low interest rates and all of that QE. The proof is that it's not helping as the manufacturing and service sector data comes out extraordinarily weak, and the numbers now nearing 50 are near recession numbers. The Eurozone, they're deep in it. Their PMI at 47.7. Japan, well, the Bank of Japan, they now hold, I saw this report this week, it's been growing, 73% of the total of all ETFs in Japan. Can you imagine that? That really does make them a communist country, doesn't it? 73% they hold of all the ETFs. All of that qualitative easing, and they can't get their economy off the ground. Well, the central banks all over the world put us in this tragedy, and that's how the history books will write it down many years from now when students are studying about more Keynesianism and the craziness that we lived in during this period. Stock market, well, following our technical scenario pretty perfectly. The weakness was due to continue and continue through mid-June. We see that, and we talk about that in our Future Speak show on Wednesdays. That's for members, level 2 and higher. And we're going to some deep analysis in 24 different futures contracts, and we show you the broader analysis in the stock market and why we look for that big decline into June. We think there's likely to be a capitulation on the downside at that time. Once the S&P 500 breaks 2,800, it got some support there a couple times, then we think that we're going to get into that period of harder selling, that capitulation. That should set up a pretty good summer rally that we're looking for. But then I think that rally may very well be just like a wounded duck, as it's flying up there but not able to hold and eventually comes crashing down. We're looking for much lower stock market in coming years in the near term. So 21, 22, some dangerous times out there. But in the meantime, we might get this wounded duck to test the all-time highs. Kind of what we're looking for. Stock market, well, the major index is down 1 to 2% for the week. NASDAQ was the worst as the techs are really mired in the trade war right now. We've seen some very big hits in the semiconductor stocks, and there were so many people that wrote me about how bullish they all were about the semiconductors, and of course, that's why we came crashing down in that group. Bond market 30 years up 1.125 points. The TNX, that's the 10-year, down 7 basis points. That's the 10-year yields down to 232. Interesting now, the 1-year and 10-year are now inverted by, well, just 1 basis point. Pretty flat when you look at that. And the 6-month to 10-year are 9 points inverted. So we've got a very wiggly yield curve out there, and it's not conducive to strong bank earnings. And this is how it sets up recessionary or slowdown periods. So that's where we sit right now, and there's a strong message there. We looked for bonds to do well, and they did. Gold market, well, they tried to sell it off early in the week. It got down near a pretty dangerous area and then turned back to the upside. Up about $6 on the week on the better recovery on Thursday. Dollar, well, did the opposite. Rallied early, got up to a resistance, reversed very sharply, down about 0.3% for the week. And you'll see in the end of the show, when we do the short-term view, we think that gold is in for a better time of it, but really we think the dollar is going to get hit, and that'll probably help the gold market. Oil, well, this is the worst week of the year, down almost $5. That's nearly 8% on the downside in the week. That was a really bad week for the oil market. It's all about slowdown in the world economy, but add to that, I've said many times, U.S. production very strong, and U.S. inventories surprisingly are growing where they thought they'd be falling, and that has the oil market quite soft. And even the geopolitical issues with Iran are not saving it. That's the opening. I'll be right back.
Here come the best stocks for the week. These are stocks that had big rallies, usually driven by good news. Watch as Slim shows his cycle analysis and discusses if there are more gains to come, or if the odds are high, these upside moves are selling opportunities.
All right, so what we're going to look at here are weekly charts, when we're going to look at the 5 best and 5 worst stocks for the week. There was a lot going on this week in retail. Retail stocks moved very significantly, and 2 of the best stocks for the week are in the upside here, and the best are retail, and 3 of the worst are in retail. So I'm going to show you 5 out of 10 stocks now in retail. Well, our stock sectors video that we did on Thursday examined this retail group. There are very strong stocks, very weak stocks, and very good opportunities. While I show you 5 right now, that video does give you 31 stocks that we do our analysis in, and I think you're going to find them very interesting. Follow us on Twitter at askSlim, and also become a YouTube subscriber. If you like this video, make sure that you give us a thumbs up. It does help us. And of course, we want you to become an askSlim subscriber and member. So go to the askSlim.com website and check out what we have to offer. All right, so now let's take a look here as we switch over to Target. This, of course, our weekly chart with cycle analysis. That is where the core of our work is done. On 84 symbols that make up our focus list, we do weekly and daily analysis, and you won't need to trade anything else if you look at those 84 stocks. So here's Target. You can see on the bottom there are some overlapping cycles there. We also have the Walmart cycle on there, so that's why you see the overlapping. Here's the area we expected a low to come right over here in Target. That's that black cycle bracket right there. And then we thought it would get into the rally phase right here. It hits the support buy zone that we've had in there and explodes. This green area you see shows a positively configured cycle. Usually you get another one after that, and our target zone right up over here is near $89 in Target, now trading at 81. Very strong earnings. It was a perfect spot for it, up 12% on the week, and one of the two really good upside movers that are in the retail sector. Take a look here at Deckers, D-E-C-K, and you can see basically one cycle after the other moving strongly to the upside, one little consolidation one right in there, and now moving up sharply again. This is really a great pattern, and I've got way up there is where our fib target zone is. So you have these positive cycles going on. You can see them right there, and the expectation is that it will get beyond the 61.8% extension. It will likely get up here to the fib target zone. Our target 176, that's about $22 more from where it is right now in these patterns that are quite bullish. You can see this declining phase right in here, the new rally phase right in here. What's the likelihood that 1 week only will make up the whole thing? Well, nothing really. I mean, look at all these. This is 10 weeks on the upside, 7 weeks on the upside. This is 3 very strong weeks on the upside. And this was about 3 months on the upside. So this is the first week up in this cycle. It's very, very likely to move up. We talk probabilities, and the probabilities are very high that it's going to get up here into this target zone area right up there. And we think this stock is a buy. We talked about summertime being a better time for the market, and that ought to help this stock also get up to our targets. Hewlett-Packard, the next one we're going to look at, HP Corporation is what they call it. Isn't this a pretty chart? You know, we call our charting work a chartistry. We got that from one of our viewers. It's a great term, and this gives you a good example of how we put in colored phasing at times based on the patterns that we see. And when you get into a red zone like you see right over here, it's very susceptible. That was created when you broke this low right over here, and it brought the collapse. You can see a very similar cycle right in here. It didn't move down quite as sharply, yet it got nice support, double bottom right here, as you can see that, and now moving up. Now this is our sell zone. The reason it's a sell zone is because the downtrend is still intact. We believe that the stock will get up between 21 and about 22.70 and then reverse again. So Hewlett-Packard moves up sharply, moves up 7%, earnings beat, and the analysts have been raising their targets in there, but this needs work. It really does, and we think that that work will come between now and sometime in August, where it kind of moves around in here, and then maybe after that it can have a trip up and do a lot better. So Hewlett-Packard, good gainer, 7%, and a chart that looks like it could rally also into the summer. Here's another giant one, a big mover in here, is you got a 5% moving into, but that's just adding on to what has been a very strong pattern. Interesting, you can see this negative cycle right in here where it actually closed lower than it began. The probability of the next cycle taking out that high is really only about maybe 25%, but it did it, and it was really strong. And now you're set up again. So you can see this declining phase right in here, and you can see where it declined. Take a look at the declining phases. When it only moves down a couple weeks, it's super bullish and then continues up in a big way. When it moves down sharply like this, but really only gets back to the support areas, well, then you're usually in good shape to get up to the fib extensions, where you could see right there. So our targets that you can see right up in that area are above this 277 number. That's 277, 287, and 303. We think it's a high probability that Into gets up into that area. Earnings really good, analysts upgrading the stock, and we think the stock is great. And the last one we're going to look at in here, in the 5 best of the week, is Humana. Now, Humana has been a bad stock, and we were bearish on this and the whole group of HMOs and healthcare, and we think that, the Democrats are coming, and that's why these stocks are getting hit, because their policies are not good for this industry. Now, President Trump came out, and I think that he made some comments that are helping this group right now, at least temporarily, and you could see that it's moving up sharply and getting into the resistance zone. It's more about more transparency. In other words, they're going to be mandated to say who they charge what prices, which would increase competition, and increase competition to lower prices is, of course, the right way to go. And this is better than the Democratic destruction that's potentially coming. So I'm trying not to make it political, but much more about trading. And trading says to me that based on what I'm hearing and based on what I'm seeing, this decline ending, this rally beginning, that this is a rally into the summer that likely gets you to 271 up to about 281. Right there, and what could be a nice rally in the group, but a rebound in there, and I don't think it's going to be all that powerful and last all that long. That is the best 5 stocks that I have for you for the week. Some opportunities and some just interesting. Take a look now at what's next.
Coming up are the worst stocks for the week. There are some real stinkers here. Some of these are breakdowns or extending losses in really bad chart patterns, and some present great buying opportunities. Watch as Slim makes that all clear to you with his very unique analytical style.
All right, for the worst stocks for the week, again, we're going to be bringing in some stocks that are in the category of retail because they were all over the tape this week, so important things to look at. Now, when I did my review of the retail stocks this week, Foot Locker was still in an uptrend, and that changed very significantly when it came out with its earnings report. You can see the uptrend that has existed in here and the multiple rising cycles. Now, a good bullish cycle right in here you can see, and a good one right in here, and each of them going up the channels and making higher high. This being the directional component right over here that moves these ideal cycles up so they look like this instead of like this, and you get a lot of strong messages from that. Here, this interesting that engulfed right over here, which made the top of this move, and then started to move down. And as of just the middle of this week, the stock was at a point where it could have rebounded again. However, that changed as the earnings came out. This is now an updated chart for those of you that saw that video, and earnings really missed by a lot. Sales were much weaker than expected. And now you could see this low right over here and this low right over here. It got a little bit lower. It now projects to the sell zone that's created up here. We could see this stock rebounding in the next month, month and a half, up to about 52.5, but that would be a long shot if it can get there, honestly. We think there's some lower resistances in here that we'd look at potentially that would stop the upside rally. This is the end of this now. And of course, when you have the trade war going on, and the shoemakers have been screaming about that, all of that can be a negative for this group. And Nike's pattern is breaking down, in our opinion. That's been a great stock, and we think you can look at Nike for potential short positions. So I'm not going to show you that one because I'm only doing 5. But I really think that it's important for you to take a peek at a Nike that could be breaking down. Kohl's is the other one we're looking at that broke down very clearly. Now, take a little closer look right in here. This is interesting because you see we had our extensions right up in here, our targets, which it failed. It didn't quite get up to the levels we expected. And then it broke down in a very bad way. This has about 3 or 4 weeks left to go on the downside. And were it to be able to get a bounce, well, bounce now, we think it's a sell, or if it bounces later into the summer, we think it's a sell. So we have our resistance zones in there. We think that it could get back to $60 in the summer if we had a really good stock market. But overall, we do not like this stock and another retailer that is really badly damaged. You know, when I talk about retail and I talk about the whole group, most of the group was not in good shape, and many of the stocks in pretty bad shape. And you got to think about the consumer when you think about that, because the consumer revolving debt and credit card debt is over $1 trillion. It's at another record, and that has to mean the consumer, which is 68% of the U.S. GDP, is going to help with this slowdown that's going on. I just can't see them helping this economy grow right now. If anything, they're going to help the economy slow right now. So I just wanted to put in that little tidbit, because I think, being that I've focused so much on retail this week, it's important. A few of them are looking pretty decent, as I just showed you, but there are more of them that are not looking that good, in my opinion. Let's take a look at a very, very unusual pattern in Qualcomm. Qualcomm, another big loser this week, where Foot Locker and Kohl's lost 20%, Qualcomm loses 14%. This is, you could say so much for good news on the Apple settlement, as that goes to appeal. And they're just also very stuck in the middle of the trade war, and analysts have been downgrading this stock. So the stock moved sharply up on that news from like 58 all the way to 90 in a few weeks, and now here all the way back down. Now, this is a support zone, but this is a terrible pattern. And even though it's likely the stock is going to get a rally, and you can see based on this, the rally might not start for a couple weeks, but a move up into this area off of the support is likely to fail. So you can see the gap down right in here, and that's a gap on a weekly chart, which is pretty rare. That means that it had a bad down Monday and then collapsed. So this is a bad pattern. Even though it's at support, we're going to look for rebounds somewhere up in here to the 72 to 75 area. And I think the stock is a sell if it gets back up there. The next stock we're going to look at is in the natural gas category. Now, energy is super weak, and I told you 6%, almost 8% down in the oil market this week, as it's turned incredibly weak. Now, I like this. I like the patterns in here. I think that we're going to get a bounce in the energy sector pretty soon. This points to a low due very soon. You can see the intermediate support right there. I think Devon is buyable. Now, the stock is down 12% on the week with the oils, but this is a big spot and good timing. And I think for people that are, speculators, I would start looking at this stock around 25.5, 26.5 area for a rebound in there. That is Devon, and with the energy group on the downside. And the last of the retailers that we're going to look at, this is a horrible pattern. So this is Lowe's down 12% on the week. Earnings miss, analysts downgrade the stock, and I say sell the bounce when it comes, if it comes. So this is a great example of the basics of cycle analysis. You can see in here, I'm just going to look at these three what we call harmonic families right there. There is a dominant cycle right in here, the big one, and each of those made up of two minor cycles. They're highlighted in blue here, as you can see. And when we get to the cycle that's still live, I leave dotted lines, so you know that. You can see what happened in here. You had the first minor cycle and then another rally. You got this right up here and made a perfect double top. Now you've come down and broken this low and broken that 61.8%. That's negative. Their major supports are down here at 85, and the stock is now 95, and that's a reasonable target. This low is due the first week of August, and you can see when you get into these periods of nesting or where two cycles are declining, there is a lot of risk right over here, you can see, and this risk does not end until August. So first week of August is when we expect the low. We'd look for 90, possibly down to 85 right there. If low got a rally in here, I think it's going to set up a very, very good shorting opportunity. 12% down on the week, and I think a lot more to go in there. So that is the best and worst stocks for the week. I hope there were important, good tidbits for you in there. If you were a holder of stock that looks bad, well, I think the information is valuable. If you're looking for opportunities, well, there's some good ones in there, especially when you look at Devon, I think, which is at a very important area. That's the best and worst.
Next is Slim's short-term view for the coming week. Watch as shorter-term charts are used to project 5 major markets in price and time. And there is also an emphasis on momentum to help keep positions set with the highest odds of catching the biggest short-term moves.
All right, so we're going to look at the short-term view for the coming week. I'm focusing in on daily charts when I look at this, and those charts are we can tell by how many views come into each of the sections that we put up there. And of course, this is a very heavily watched a segment of the show. And if you're interested, and we can tell that the greatest interest is in the stock index futures, please do consider becoming a level 1 askSlim member. Level 1 gives you our stock index report, which is a very comprehensive report on the 3 major indexes that people love to trade, the S&P 500, the NASDAQ, and the Russell. We show you our weekly and our daily analysis. We give you our momentum studies in there for the short term and the intraday for those of you that are active traders. We give you important levels. There's so much in there that is just incredibly valuable. Plus, you'll get our ETF review where we compare some sectors in the markets and give you important information on those sectors also. And we show you whether we're bullish or bearish in each of the time frames. Plus, you'll get a whole group of special videos that are included in there. That is, I think, a great value at just $23 a month. So if you're interested in stock indexes, I mean, this is some great information. Please go to the website and then become a level 1 subscriber. All right, so every week we do this. We look at the these daily charts, and what I'm going to give you is how we did also in the last week. We were wrong in light crude. Light crude was a lot weaker than we expected. Gold, the dollar, the bond market, and the stock market, we were all correct on. Very, very good. And we get an 80% this week. That is pretty rare because we try to shoot for 60 to 65%, which would be 2 to 1 correct. And this was really a very good week, and I think that those of you that are focused in on these indexes really have seen that. Let's take a look as we switch over and look at this daily chart of light crude. There you go, and you can see our cycle analysis in there. So something in here is happening, and it's not great. You can see in here that there are 3 different sizes of cycles, and I want you to note the dotted line right over here, and we have a note. There's a shift likely. Why do we say that? Well, we expected a bottom to come right in here and this sell-off. That all was correct. Then we got a rally, and it hit the resistance zones. It's pretty normal for it to stall there, but then came down to a lower low. So this blue line now signals that we could be getting a shift over into this direction. It points to the fact that there's still risk in this market right now, and I'm going to zoom in for you to see that. So here's the minor resistance zone that you can see there. That minor resistance zone, we believe, will hold an upside rally. That's at about 59.90 at the bottom of that zone if there's a rebound. So for the week in light crude, we're expecting it to try to get there and then turn down again and then test these levels around 57.5 again. The bad news is that the rebound might not even come, and it could even get lower on the downside. Now, this bottom support here is at about 55. That's from the intermediate patterns. So that could be a reasonable target, but we're gonna say that it's oversold in here by a little bit and try to get a bounce up there. Note that red arrow 2 days ago created negative momentum. It's been choppy to negative momentum right in here. Now the slim ribbon is widening as it moves down, and that's not good for it. So we believe this negative momentum and this negative pattern that we're seeing in here is going to mean that there's about 5 to 8 more days of this decline right in here. And that means that if you get some bounces, they're shorts. I mean, that's just the highest probability. So that's a look at the light crude market, which this weakness that we see here is greater than we expected it to be. The gold market, which we did nicely, we expected it to dip and then rally. We got that. We were hoping it hold above this area here at about 1266. It got close, but then did it and had this big up day. It's down a little bit, wiggling here today, but we think it's going to continue to try the upside. Now, I want you to note right in here, this points to the fact that it's probably not quite ready to explode on the upside, though I have been buying positions in gold and gold stocks in this week. It's all because I think I could be wrong, and wrong in the way that it's stronger than I expect, because this was the key low area right over here, and you could move up sharply. And I also think that I'm going to show you that I think the dollar is going to move down, and that helps the gold market. I think that it could spend another week playing around in here, and then the following week move up very sharply there. But it could move earlier, as I'm saying. We're going to call this an attempted upside. Now, note, momentum is still negative in here. So until it gets to be positive, we're not going to be happy. And that means that we would expect it to fail in this area. Try to get up here to, 1290 right there, 1294 right there. Those are kind of the numbers. And then kind of flounder in here and then do better the following week. So that's what we're looking for. If it gets over 1294, you know that it's in much better shape. So that's kind of a key area. The probabilities of a big down, I think, are small based on what I'm going to show you in the dollar. So we're going to look for a attempted rally, curl down a little bit, and then setting up a much better time after that. Small up week is kind of what we're looking for in here in the gold market. Now we're going to look at the dollar. Now, dollar sign DXY, we expected it to rally and fail. And exactly, you can see that. It got up to this resistance zone that's in that fib target area and then failed in a big way, made this evening star pattern that you can see there. And that says to us that it's peaked in this cycle. So you can see the cycle peak right over here, and then it fell all this time. The cycle peak right in here and likely to fall all this time. So this takes you out to June 7th. This is a couple of weeks potential, and that's why I think the gold market can do a lot better. This, to me, is a very significant pattern, and it looks like a top. I think you can short the dollar. We've been in a position where we're short dollar versus the Japanese yen. That one looks really good. So this looks like, to us, the top in place, and we're going to see lower prices. We're going to look for a test, best case, down in this low 97 area over the next couple of weeks, and it could be worse than that because this decline lines up with a weekly chart decline also, and when they're lined up that way, you can get some big downsides. So the dollar, in our opinion, it's going to have a down week. Now, note that the momentum is still up right over here, but it's starting to curl over, and I think in the next couple of days you're going to lose that upward momentum, and we'll be watching for that. The bond market, /ZB, we thought that it was going to have an upward bias. We saw a range, and you can see the ranges that we had right in here. We said if it moved out of the range, it would likely be on the upside, helped by continued upward momentum that you see here. On our longer-term charts that we talk about in future speak, we talked about it getting up to 52, and we still think it has a good shot at getting up there to the 152 area above these levels right here. So this, what we're going to look for in the next week is some upside in here. We think that's going to get helped by a soft stock market or worse. And then the stock market rebound, and this gives some ground right in here. And then this is another period out here of weaker stocks and stronger bonds. So you can see we're looking for a choppiness out here to mid-June, and that pretty much relates to what we see in the stock market, with this being inverted to the stock market pattern. So we're looking for some further upward move, potentially getting near resistance around 152, giving us probably a small upside week with this upside momentum, and then towards the end of the week and into the following week having a dip. So that's why we give it likelihood of a small week, moving up and then giving it back right there. That is a look at the bond market. So the stock market, we thought would get a rally and fail, and that it was kind of stuck in a consolidation. It wasn't able to get up quite as high as we thought it was, but everything we said besides that was correct. And the market being in a susceptible time period to declines. And we saw some pretty nice looking declines in the stock market, and we expect that there's more of that to come. Now we're going to take a look at the S&P 500 SPX, and we know that a lot of our members watch this, and I sure hope you are looking in at the stock index report on a regular basis. And we try to update more often now than we did before, so Matt's been really good about getting updates on that. If you have any questions about our stock index report, ETF report, write Matt at askSlim.com. He'll help you with that. So here is the S&P 500, and you could see the sell zone in there. So what we have in here is this corrective period here, or this declining period, bringing you a big sell-off, 154 points in the S&P 500. Now, this rising cycle right in here, you can see that, stalling in the sell zone. What that tells you is that the energetic force that caused this break is still there, and that's likely to cause this break into mid-June. That's why we believe that the market's got a lot of problems in here. So, like I said, I thought the bond market would rally a few more days and then roll over. That would be opposite to what we expect in the stock market, as there's a flight to safety bid coming in now. So that would mean down a few days here in the stock market and then rally. We're going to look for a down week, potentially a small down week, if it can hold the 2,800. If it breaks it, you could get much sharper selling into this period right here. So 2,800, we think it's going to get tested or broken in the next week, and that the following rally after that will fail, and then another big down wave right in here, like you had right in here. It's kind of an ABC pattern that we have projected, and this being the very riskiest period right in here, because you have the intermediate cycles coming to their bottom or capitulation area at the same time, so there can be a very large break in there. This is a very bad pattern. We're going to call a down week. We don't know if it's going to be a small down or big down, depending on that 2,800 there, depending on what kind of news comes out where. Momentum, you can see it turned negative and has now remains negative right in here. And note here, when the projection oscillator got overbought, it brought that sell-off as it's supposed to do. So this right over here is a bearish confirmation, and we're just going to look for a zigzag downward move. This price target right over here is around 27.30, and we think it's a reasonable price target in mid-June. So we'll see how this all shapes up. You can see how pretty we have this drawn. And the sell zone working very nicely. Remember, negative momentum, that's a key, and a late cycle correction going on that brings you potential free falls and capitulations, and that's what we're really looking at as a risky situation for the stock market. I hope that this was valuable to you. Please do become a subscriber. A member at askSlim. You can do it for free. You can pick any one of our other 4 memberships, and there's good detail there about what you get from it. If you like these charts, you can become a level 4 member and get our proprietary charts on the Thinkorswim platform, our preferred broker. So just a ton of information, and the more of you that come on, the longer the askSlim life will go on, and we're building it, and we have Matt and Arvi and Eric and our whole team, support team, and it's important. Please do become a subscriber so that we can keep bringing you all of this great information. I want you to be so careful. It is so crazy out there, and I'm always wishing you great trading.
Well, I'm going to the city.